Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. A big day today, RBA makes an announcement at 2:30 this afternoon, whether it will cut interest rates. Most are predicting we'll get another 25-point cut. Doesn't really matter that much. The trend is certainly downwards and money markets are pricing in a full 1% cut over the next 12 months. So whether we get a cut today or next month probably doesn't really matter. Lower interest rates are certainly stimulating the property market. CoreLogic released its data last week that for the June quarter that showed Darwin was the standout market, 4.3%. Perth and Brisbane did pretty well, 1.6%, but that's no surprises there. Probably the biggest surprise was the turnaround of Melbourne. Adelaide did 1.3%. Adelaide's been a standout performer, but Melbourne wasn't too far behind, 1.2%, so only 0.1% behind that. And Melbourne's slightly better than Sydney in terms of returns. The numbers don't really matter that much. It's one quarter's worth of data. Let's not get too excited. But I think the key thing here is that Melbourne has started to recover. And, that's obviously a good sign and certainly not unexpected. On the annual basis through to June, we've still had negative growth in Melbourne for property prices. Well, the home value index at least down 1.2%. But I guess the key news is that in this calendar year, that's when Melbourne has started to turn. And that's good news, I think, because it's sort of a signal that we've seen the bottom of the market and hopefully we see some pretty good growth from here on in. Adelaide and Perth were the best markets for the 25 financial year, 8.6, Brisbane 7.1, pretty solid growth there. Sydney only 1.1, so pretty much, that's less than inflation, isn't it? No major change there. So good signs, I guess, in the property market, and it'll be, interest rates are certainly going to help, I think, the Melbourne recovery. Okay, so let's get into some questions today. First question is from Alex, which is a pseudonym. Alex writes, "Thank you for developing such an engaging, informative podcast series. Along with The Money Puzzle, where I noticed that you're a regular guest, are the only two financial podcasts I listen to, and I've recommended the podcast to my wife, my two adult sons, 20 and 22, and at least a dozen friends." So thanks very much, Alex. I enjoy joining James Kirby on The Money Puzzle. I also write a few articles for The Australian as well. So The Money Puzzle is a podcast by News Corporation or the Australian newspaper. It's interesting. I need to write, if I'm going to write something for the paper, it needs to be newsworthy, which means it's got about now. And newsworthy means really that the topic will go out of date relatively quickly because it's really just is about current sort of content. But I don't actually like to write about that sort of stuff, really. Sometimes something's going on, I want to talk about it, but mostly, and particularly in this podcast, I want the content to be evergreen just because I believe that's the best approach when making financial decisions is evidence-based, long-term, all these sorts of things. And so what I say today should still hopefully hold water, 10 years from now, for instance. But anyway, it's a bit of fun. And the Money Puzzle, I do listen to it as well, just so I kind of keep up to date with the guests that James has on the podcast. I think it's a good one as well. Okay, so let's get into Alex's question. Alex is 55, his wife is 52. They're small business owners and have been for the last 15 years. They own their home outright, $2.2 million. They also have 5 investment properties, 4 in a family trust, 1 in Alex's wife's name. Total value of those 5 properties, $3.6 million, no debt. Generates net income about $85,000. Which is a 2.3% net rental yield. Not too bad, but it shows that property really doesn't drive a lot of income. They also have about $200,000 in shares in the family trust that nets about $5,000 a year in terms of income. And Alex receives a military pension about $20,000 a year, providing about $110,000 a year in terms of passive income. Currently, the trust income is distributed to his adult sons and his wife, and they aim to keep their incomes below the Div 293 threshold, which is $250,000. Living expenses are about $140,000 a year, and they're able to save between $150,000 and $160,000 outside of super that previously went towards reducing debt, but now being directed into ETFs. In terms of super, they've got that in industry funds and have approximately $850,000 each. In addition to the above, accountant values their business at between 1.3 and 1.5, and they have 1.1 million of retained earnings trapped inside the business that's invested in ETFs and deposits. They intend to sell the business in 2 years, retiring at 57 and 54 respectively, and divide the proceeds into super to give us a balance about 1.5 million each. We've already gifted one of our sons $50,000 to match his savings and load him $100,000 over 10 years at 1% to help him get into the property ladder, and we'll do the same with the other son. As you can probably gather, so here's the question. As you can probably gather, we're very conservative with our investments and have chosen to pay down debt rather than leverage more into property over the last 6 years. However, now I feel belatedly that we should get back into debt and buy, in our names rather than the family trust, an older style 2-bedroom apartment for up to 750,000 in Melbourne that we can rent out for 2 to 3 years and use as a Melbourne bolt hole in retirement. Assuming we purchase the Melbourne property, should we pay it off when we sell the business with the retained earnings and trigger extra tax, or super, which reduces our tax-free income, or live with the debt in retirement? Would like to achieve a perpetual income around 200,000 in retirement. Is this achievable if we buy a Melbourne property and retire in 2 years based on the net assets and business sale? Lastly, would you take on Sydney residents or so close to retirement like ourselves as a client? Okay, Alex, there's a lot in that one. Firstly, well done. I mean, you're in a fantastic asset position and, retirement's going to be well and truly achievable. But I guess there's some big ticket items that you really need to think about. And when I get these sort of case studies, if you like, or scenarios, I like to just look beyond the question that I'm being asked. I'm not just answer the question. I like to really talk around the case study because I think we can all learn from it. Well, hopefully everyone can learn from it. And, if there's any other sort of considerations that Alex might not have already considered, for example. Okay, so let's talk about them in no particular order. The retained earnings in the company I really dislike. Now, I don't know what the company does and what the risk profile is and all those sorts of things, but just as a general rule, I don't like to have any retained earnings in a company. And the reason for that is that it's an asset protection risk. Whether an employee takes an action against you or whether it's a creditor, customer, there's a lot of retained earnings in that company. I've got something to sue. Whereas if the net assets are minimal, which is really what the aim should be, you're not going to be a target because I'll get the financials or, through discovery and, I'll work out, okay, there's not much money here and we've got the corporate veil and what's the point? You can't get blood out of a stone. Plus also you've now got an issue, right? You can use a small business CGT concessions, the 15-year retirement exemption, for example. So we sell the business, we don't pay any capital gains tax on that amount, but we've always got this retained earnings issue. Plus also then you're going to, you've got to work out when you sell the business, will you be selling the shares in the company or will you be selling the assets of the business? Now that's going to depend on the type of business you have, whether it has any sort of licenses or registrations that need to go along with the business. But if you just sell the assets, will you live with any legacy liabilities? So if someone comes and sues you for some work you did a few years ago, that rests with you rather than the new owner. That's okay. You can kind of assess that risk if you like. But it just becomes really messy. We just helped a client, prepared some advice for them. Similar situation. They had millions of dollars of retained earnings, and it's really becoming a problem. They've got some Div 7A loans as well. It's a bit of a mess, even though they used a pretty large accounting firm. It's a bit of a mess, and it's creating problems in terms of the business sale. So that's the first thing you want to work out, and anyone wants to work out in terms of their exit strategy and retirement strategy. When we come to building a plan, we typically ignore a business sale proceeds, right? So we try and build a strategy just assuming we can't sell the business one day. Just that's a really base case. But we still always think about, okay, if we're going to sell this business, how's it going to work? How tax effective is it going to be? And the problem here is, yes, it's great to try and avoid Div 293 tax, but sometimes that can come at a cost in terms of, if I feel like, well, I want to reduce my amount of gearing, my negative gearing, just to avoid paying $4,500 in additional tax, which is the extra 15% on 30,000 of super contributions. It's a false sense of economics. So, for example, I've got a lot of gearing, as you should expect in this podcast, a lot of gearing, negative gearing in my personal name. My wife and I do. We have to keep our taxable income relatively high to make sure we get the full benefit of that negative gearing, which means I pay Div 293 tax. But my savings in terms of negative gearing are more than $4,500 a year or whatever the Div 293 tax is. So that's something to really take this holistic view, right? Which I keep talking about, is rather than just trying to minimize income tax in financial year 25 or financial year 26, take this holistic approach about what is the longer term outcome here. And sometimes paying a little bit more tax along the way is far more tax effective in the long run than just kicking the can down the road. Because remember, and this is something I think, I invite everyone to really recall and remember, it's very difficult to avoid tax completely, but you can delay it. But the longer you delay it, potentially, the bigger the problem you have down the track, right? So sometimes people think, oh, gee, I've saved tax this year. Have you, or have you just delayed? Because if you're just delaying, you're just kicking the can down the road. Okay, my next comment will be asset allocation. Fantastic, you've got really healthy balances in industry super fund. As I said, you can use the 15-year retirement exemption to avoid any capital gains tax on the business and put it into super. That's really good too, because you get to use those lifetime super caps of $500,000 each that you can put into the business to reduce the capital gains tax. So that's fantastic. And that's one example where you actually can avoid tax rather than delay it. And it means you'll have really healthy super balances, but you've got $3.6 million in a family trust that is generating 2.4% in terms of income yield. Not great. It's probably going to attract more and more land tax as we get further into the investment journey, and also ad hoc maintenance expenses. Now, this is the issue with property inside retirement. As we all know, if you're a property investor, you can have a great year and there's not many expenses. That's a good year. And then you can have other years where, just random, a whole bunch of maintenance expenses come out and, really eats into the investment income. So you've got potentially a rising tax environment because if you've got property in a family trust, and I don't like property in a family trust because it tends to attract in most states a higher level of land tax. It's a drag on income there, and they're not the right assets for Alex's age and stage of life. So Alex has done all the hard work, invest aggressively, pay down debt, build equity in a business. So his asset base is really strong. Now what we need to do is tilt it towards more to income, more to liquidity, and more to assets where we can manipulate the risk profile and volatility of those assets. So, Alex needs to start thinking, not now, probably, because you want to try and minimize CGT as much as possible, but certainly in retirement, gradually divesting of that property in the family trust and then using the non-concessional caps. And you're going to have to be pretty aggressive with it because the bring forward contribution caps for non-concessional taper out about 1.7, 1.8. So you don't want too much more growth after you sell the business to be able to use those 3 years. And it's based on your balance at 1 July. But if you straddle 2 years, you can make 120 this year, for example, or in June, and then 360 in July. So you can get 480 in, so $1 million between two spouses, and that will allow you to potentially sell property in the trust and then get it inside super. And remember, the goal is to have a couple of $1 million each, because that's the transfer balance cap now, in super that's going to be completely tax-free. Now, a quick comment about the income profile as well, because this is a bit of a misnomer. People think, okay, well, I want 200,000 of passive income, so I need to look for assets that are going to give me 200,000 of passive income. And as I went through the description in the question, Alex's passive income now is 110,000. So then he might be thinking, okay, where am I going to get the extra 90,000 of passive income to bring it to 200? Not the right way to think about it, because actually thinking about it that way will invite you to make asset allocation mistakes. So be too focused on income at the expense of longer term returns. So instead, what Alex should be thinking about is, I have, X value of assets, or just as a rough calc, including the business, about $7 million of investment assets. If I earn 7% return on that, that's about $500,000 a year. If I spend 200,000 of that, I get to reinvest 300. That's a perpetual portfolio, right? That the balance of the portfolio continue to rise perpetually, and he'll never run out of money mathematically. He can live to 150 if he wants. So that's the best way to look at it. And then what you need to do is then think about, okay, how do I invest this so that I take the amount of risk that I'm most comfortable with, that is most tax effective, that's got the highest probability of delivering 7% in terms of compounding long-term returns. And that means you could have, a combination of property, equities, shares, and defensive style investments, as I spoke about last week. And then you just have, a portion of those assets, a portion of that 7 million in very liquid, stable assets. 2 to 3 years of expenses, for example. So again, in Alex's situation where he wants 200,000 a year, you might have between 4 and 600,000 just invested safely. And then what you do is just gradually, depending on what market's doing, is rebalance that portfolio every 1 to 2 years. So as you eat into those safe assets, you can take some profit. So for example, at the moment, share markets, or at least when I'm recording this, share markets are all-time highs. So there might be things in the portfolio you think, we've got too much concentration because they've increased. If you've got US investments, last 13 years, you've got 13% compounding returns. Those now make up too much of the portfolio. So I'm going to scrape some off and then replenish, how much I have in these safe assets to pay for this annual income. So that's the best way to think about, how much I want a $200,000 income. It's really about what return on my overall portfolio do I need in order to generate that, plus then a little bit more as a buffer. And that informs you that, hey, I don't need to take too much risk. So in Alex's situation, for instance, he doesn't really need to take too much risk in order to earn that return. I mean, only really needs a 3.5 or 4% return, which is going to be well and very easy to achieve, even if you just put it in very liquid investment. So, should you buy a property in Melbourne, which is kind of the question that Alex was asking in the beginning? I wouldn't if I was in Alex's situation. Building more capital, is it really going to change your life? It's not. I'm not trying to talk you out of doing it, but I recorded an episode a few weeks ago talking about, how much money do you really need? And what do you want to do with the money? So, of course, you probably want to pass, some of that wealth on to your sons eventually. I get that. So you don't want to spend it all. But what else, what else can you do with your life in terms of living expenses, maybe retiring sooner than a couple of years, those sorts of things? You've got more than enough money than you'll ever need, I suspect. And you've got too much in property already. And it's not going to be as tax effective. You're still going to pay land tax. You're still going to pay capital gains tax. Whereas you might want to think about, a different approach. The other thing you could do in your situation is have a corporate beneficiary as well, particularly as your sons, if they go into the workforce. If you've got more income than you really want to distribute to yourselves, you can distribute that into a investment company. And so adding a corporate beneficiary might be something you want to do down the road. Very, very long-winded answer to Alex's question, but hopefully that gives, all the listeners that are similar position to Alex, I hope to be in a similar position to Alex, some things to think about. Okay, next question is from Francois. Francois writes, I've been listening to you regularly on the Investopoly podcast during my commute and really appreciate the balanced views that share with the community based not only on dogma, but instead on facts and with an open mind. Thanks, Francois. That's great. I've got one question I'd be really interested to run past you about fixing potentially incorrect structure for a property. Here's the background. We're both 50 years old and I purchased a property with my wife 50-50 in personal names. It was going to be our home, but for various reasons we've pivoted and we're going to do a subdivision and build 2 rooming houses on the property. This will be positively geared with about $40,000 of after-tax income. My wife and I are respectively on the 30 and 45% tax bracket, so 32 plus 40, 32 and 47 with Medicare levy, of course. There will be work involved with managing the 2 rooming houses, invoices, contractors, tenants, etc. To try and fix our structure mistake, is there a way that we can set up a family trust or company that will be in charge of the rooming house management? The management fee could be kept in the company at 25% in 25% tax rate and invested in shares like a third super fund, as I sort of talk about. Keen to hear your options. So again, Francois, I'll talk about, my wider observations with this. I've seen a few clients do okay with, running rooming houses. But let's be clear about it, because I talk about, actually in the book Investopoly, I talk about the three ways to really build wealth: business, passive investment, and speculation, right? They're typically, if we talk about the broad categories, and it's really important to be really honest and upfront about what strategy fits in each of those boxes, right? Because sometimes I find that people fool themselves into their investing, but really it's a business, or they think they're investing, but really what they're involved in is speculation. So let's really be honest with ourselves about what those things look like. And in this podcast, I just talk about passive investing, right? It's about earning the highest income for lowest risk. There's plenty of other podcasts in those other spaces, so I'm not going to compete there. In this situation, though, it's a business, because you've got a rooming house. Rooming houses, sometimes the tenant turnover can be higher, but there's a lot more moving parts than, a passive investment property. And also, sometimes mostly these rooming houses sell on a yield rather than sell on a, sort of intrinsic value, if you like, land and improvements like a normal residential property does. So, they'll sell to an investor, say you can buy this, property and it's going to earn X net income. And that's really what's driving the value or the price, much like a commercial property. Now, I think the key thing here is to work out, and the key thing here, when your situation changes or your decision changes, one of the things you need to be really careful of, and particularly if you're 50, because if you're 50, you don't really have a huge runway to course correct. If you're 20, you do. You can make a few mistakes and you've got plenty of time to fix it. But as you get sort of deeper into, life, of course, you've got less of a runway to fix these things. So if you buy a property and then you change your mind, you've got to be really, really careful about designing the strategy around the asset. And that's something that is a very common mistake. Instead of develop the strategy and then pick the assets that best suit that strategy. That is a far better approach, a far better strategic approach than trying to design your strategy around your existing assets, because it'll invite you to make a mistake. It'll invite you to, make not only an asset mistake, but then also a strategy mistake. And, as the saying goes, if you find yourself digging a hole, stop digging. So the first thing I'd ask in this situation, particularly if the ownership structure isn't ideal, where you've got half of the income going to someone in a much higher tax bracket, is that will this property contribute to our retirement? The other thing as well is you've got to be honest with yourself about the challenge associated with running a rooming house. Right? We can say, look, it's not that big a deal. We're looking for a little side project, all those sorts of things. But, one of the comments I get all the time, and I think to myself as well, is that property is a great asset to hold, compounding capital growth, all that sort of stuff. I'm not talking people out of it. But every time you get a request from the managing agent, this broke down, or the tenant wants this fixed, you think, oh God, just more money to pay. Right? And it's just multiply that by a factor of 2 or 3 or 4 or 5 with a rooming house. So I think we've got to be really realistic about it as well. The other thing too, $40,000 a year, great. That's a good income stream, but maybe that's not the best thing that you can do with the equity you've got, the borrowing capacity that you've got as well. So it's good. We can put that, as you said, you can reinvest it, so forth, but it's maybe not, the best question then to ask is, if you didn't own this property, would you go and buy it? And would you do what you're doing? Because maybe the best way to fix the non-ideal ownership structure, is to sell the property. Now, you might decide to do the subdivision, build the rooming houses, run the business for 12 months to get some income history there, and then sell it to an investor. You might decide to do that. That, in fact, could be the best way I'm not suggesting it is, but it could be the best way to maximize your exit value. So I'm not saying don't do it, but I just think, you've got to go back to your original strategy and work out what's the decision today that I can make, so that in 10 and 15 years' time, I look back and I go, in 2025, I absolutely nailed that decision. And certainly what you want to avoid is in 10 or 15 years' time, looking back to 2025 and going, bugger, I wish I made a different decision. And remember, the premise around in the Investopoly book is that very few financial mistakes occur because of random bad luck. Most financial mistakes can be taken back to a fundamental error, and those 8 rules in Investopoly book, really the fundamental errors that I've seen over the last 20 years that have been made, and if you just follow those rules, you're not going to make those errors. Sounds like a big plug for the book, right? But it's a really interesting exercise. It's a really interesting situation. I see it a lot where people buy assets and think, oh, well, I got it now. I may as well use it and try and use it and maximize it. But you've got to go back to, not being influenced by sunk costs. And sunk costs are decisions that we made yesterday. We don't let them weigh on our decision making today, because you just end up sort of compounding the mistake. Other than that, yes, you could have a management company in there and paying them a management fee, but you would absolutely have to make sure that that management fee was commercial. So I'm not really sure, which means that you can make a profit, but I don't know if it's going to be that tax effective, net of the additional compliance costs of running the company. And the warning here is that think very carefully about the ownership structure when you first purchase a property, because typically it's cost prohibitive to change it after the fact. So I think in this situation, it really depends on the income profile of the property and how much profit you might be able to make off it. Maybe you'll be able to shift $10,000 or $15,000 of profit into the company. It's not really going to save you that much tax. It's more complexity. I'm not sure it's really worthwhile, but you could potentially do it as long as it's at a market value rate. Okay, Francois, thanks so much for your question. Sorry again for a long-winded answer. Okay, final question for today is from Jason. Jason writes, I really enjoy your podcast, finding the information very useful and informative. Thank you, Jason. I heard you mention previously about buying investment grade property. What do you consider to be investment grade in Melbourne? And in your opinion, can you buy an investment grade property with a budget of $850,000 to $900,000? So thanks, Jason, for the question. I wrote a blog and recorded a podcast. This is before the podcast episode numbers. I should have started that right from the beginning. But on the 29th of March in 2023, the blog on our website is called How to Buy the Highest Quality Property Within Your Budget. So if you just Google Investopoly, how to buy the highest quality property in your budget, it'll probably take you to the podcast. And that's where I talk about the 3 attributes that an investment grade asset must have. So persistent imbalance between supply and demand. So that is, it's got to be in a location where there's no land supply, not within close proximity. So that's really an established suburb. And that suburb has to be very desirable. It's got to be a very desirable place. Evidence of past growth. So we can look at, the sale of an apartment or property, and over very long periods of time, maybe since back to the 1980s, and it builds a sort of data set, if you like, relative to market performance. Okay. So if I was looking at an apartment, for instance, I would want to look at its growth between 1980 and say 2010. I would ignore the sort of last 14 years, because I know the last 14 years have been bad. So all I want to know is, in a good market, has this asset performed? So you want to look at relative performance, and then strong land value component. If I'm going to go and buy a brand new apartment that's just been built in a high rise of 200 other apartments like it, I know that, most of the value that I've paid is for the improvements rather than the underlying land value. It's going to have a very limited land value amount, and that's going to weigh on its future capital growth prospects. So that's what you're looking at. Can you buy an investment grade asset for $850,000, $900,000? Absolutely. Where would I spend that money? Look, if you can get closer to 900, you might look for a villa unit, in suburbs like Caulfield, Camberwell, maybe, those sorts of suburbs that are, not your Parans and Hawthorn and South Yarra, just, a little bit beyond that. Alternatively, I'd buy, an older style apartment. I really like East Melbourne as a location, not just because I live there, but I think it's just because of the tightness in supply, the proximity to city and all amenities, and it's such a small suburb, and the only way you can change supply is building sort of higher rise around the park. Even that's limited, and otherwise, development is very limited in East Melbourne, because there's a very parochial group that challenges developers and objects to anything that's going on in East Melbourne, and that's just good for property prices. So I buy an apartment, older style apartment in East Melbourne, something like that. But you could look, further afield, South Yarra, Paran, those sorts of locations. But yeah, absolutely, you can do that. And that's the sort of asset that you're sort of looking for. Okay, I think that's enough for today. Tomorrow, I've got an interesting episode for you. It's addressing the question, can property values, house values, median house prices, persistently grow at 7% or more over the next few decades? It's a question I get asked a lot about, and I'm going to unpack that tomorrow. I thought it was a very interesting discussion. I hope you enjoy it too. Until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.